Hello boys and girls, today by this video I'm going to start new section of on my YouTube channel, which I would like to call Weekend Evening Mood. So in this section I will cover different trading related topics, and the first one will be options trading topic. So I'm going to cover my option position on Deribit exchange. So it is the first attempt to trade options on crypto. So it is just paper position which I created at 21st of July. Here is 21st of July. This is the first screenshot when this position was created. So I decided to use Deribit. Actually, I have been searching for some crypto option exchange which will provide American style option physically settled exercise. So but unfortunately I have found nothing, and Deribit and Delta exchange are the best crypto options exchange I have managed to find. So if you would like to create your own account on this exchange, you feel free to use my referral link in the description of this video. It will cost nothing for you, but exchange will get some rewards, will pay some rewards for me. So Deribit is in top 20 of derivative exchange by CoinMarketCap statistic. By open interests, options is not so speculative like futures, so scalpers don't use so much options to scalp, because you have to spend some time to get some profit from option constructions. So filters should be applied by open interest, not by volume. By volume, Deribit is on 20 plus position. By open interest, it is on 17 or 16 position. So it is in top 20th, and Delta exchange is a little bit lower because it's not so widely promoted like Deribit. So let's return to position builder. Basically this position shows us our current option position, our PNL, our Greeks values. Every option has features which is named by Greece alphabet letters. So delta, gamma, theta, vega. Vega is not from Greek alphabet. So in science literature mostly used kappa for vega feature. So as I mentioned above, This is the very first position on cryptos, and I would like to try to trade volatility on options, and I made diagonal calendar at 21st of July. So here is how my position looks like. We can see that this is Thursday, July 21st, 21 minutes AM, and I created this position. So the logic was the following. Let's take a look to the Bitcoin chart. Okay, let me switch orders and history, and let's take a look to 21st of July. So this is, we can see that Bitcoin, this is position of options on Bitcoin BTC, and logic was the following. We had some movement during last week, even more. Movement was, I guess, strong, because we covered about 30% of movement, and here we are. I awaited a few days after movement stopped and created position. So the logic was the following. Because we did great movement, volatility increased. So probably it is good idea to sell volatility, because usually after great movement, let's switch to H4 time frame. Okay, here we are. This is movement, and logic was the following. I have a little bit slower internet this night because outside is hardly raining. Okay, we had movement more than last week, during more than week. So this is about 22, so I'm approximately was here. July 21st of July, so approximately here. So I awaited when local bull run will be finished, so got some retracement, and I think that it is good situation to create volatility sold position. And what I did, I created diagonal calendar. So it's actually original calendar means that you will sell the same strike but different options, different series of options. For example, here we can see two series of options. On the series I suppose time series, so we can see September and we can see August. Expiration 30 of September and 26th of August. So logic was the following. I found in option order book put with strike 20 with huge volatility. I took a look to the let me show you. Let me show you, where is it? Okay, let me show you. Deribit.com. I took a look to volatility curve and found that it has a volatility skew or volatility smile, like this shape. Basically it is like currency volatility skew. So when price go down, we have increased volatility angle and values, and not proportionality, very sharp angle. So it was it means that in case if price of BTC will go down, we have our volatility should be increased. So returning to our calendar, so basically main logic of calendar will be like this. Okay, let me just create. Okay, here's calendar. 19,000. Okay, let's just do this. So let's take a look for September's area. Hey, come on. Oh, okay, here, yeah. So we have 30 September sold one contract and bought the same strike on early exercise area. So it looks like this. Let's do in BTC to get rid of conversion rates adjustments. So, and here we are. We can see this is 19,000 of dollars. This is strike of our calendar, and we can see here, we can see current date and nearest option exercise expiration date. So if we will scroll to our date, we can see how our current PNL today in this version on this platform, it is called like PNL today, will be closer and closer to expiration date results. Okay, so logic the following: if we will if price of BTC on 26th of August will be at 19,000, we get maximum loss. In other cases, if price will be where it is now, we will get some profit, you can see. And if price will go up, we will maximize our profit. If price will go down, we will maximize our profit also. But calendar is also used for trading volatility. So we can see our Greek parameters here. Delta means linear direction of our position. So positive delta means we took long direction. Negative delta means we took short direction. If delta is closer to zero or zero, it means it doesn't matter to what side underlying asset, in our case it is BTC, will go. We always will be at the same float PNL position. It is correct if we will not take into account another Greeks. So gamma is basically derivative of delta parameter, and it will be explained in another videos. Theta is a feature which show dependency of options price, of option premium from time which is remaining to the expiration. It will be covered in other videos also. Vega is Vega is a feature which show us how option constructions are sensitive to volatility, and this is what I'm going to cover in this video. So also we have implied volatility. So it means how current traders or how current markets, what expectations current market have about this strike, this asset, underlying asset, about movement, basically how long our underlying active asset can move from current market price in both direction, short and long. So in case if historical, we have three types of volatility in options. Three types of volatility, let me explain. We have historical volatility, HV, implied volatility, IV, and realized volatility. Okay, let me RV. So the first one means volatility which was realized on previous days or previous time frame. Implied volatility is our current market expectation about future movements of underlying assets, and realized volatility is what really happens with our asset and how it has moved at current time in comparison with implied volatility. So basically realized volatility can be higher or lower than implied volatility, and realized volatility will affect to our real price of options. So that means that if we have, for example, implied volatility higher than current volatility, we can just use arbitrage strategy and sell current options in expectations that real volatility, that implied volatility at the end of the day will decrease to real volatility or historical volatility. So this is basically idea of volatility trading in options, and this is how calendars will work. So in case if implied volatility like here is in for example of 26 expiration of August, expiration date is 80%, but historical volatility, for example, 60%, we can suppose that our current volatility will decrease until our expiration date to 60% or so. That will mean that our price of option, which is market price, mark price, will go down as well, because if volatility is high, that means that market should put more risks, more deviation in current options. So it suggests that underlying asset will cover more distance at the same time before expiration. So your hedge, your insurance should cost more, should be more expensive, and that is logic. Basically it's very simple. If you think if you think that asset will go for example 1000 of points, price points, your insurance will cost for example $100. In case if you suppose that asset will go for example 500 price points, it is very logically that insurance should be cost lower, because deviation of prices is lower, and probability to cover 1000 of price points is significantly lower than cover 500 of price points. So in this case, option or insurance for your position will cost for example $40. And this is how volatility, implied volatility, and historical volatility works. Let me show you. Okay, it's maintains. Okay, here. Okay, metrics. Options, BTC. Metrics. Where is? Wait a second. Tools. Where is volatility? Probably market data. Okay. Market data. Wait a second. Historical volatility, insurance options data. Hello. Okay, it's downloaded. Okay, let it be. So basically we would like to sell some implied volatility in expectation to buy it on lower price, on lower implied volatility. Basically it how any short position works. You sell something by higher price and buy it back by lower price. But in case if we only will sell uncovered put or uncovered call, we will get let me Okay, come on, refresh. Looks like it really slowly. Okay, order book. Oh, skew. Okay, order book skew. Here is volatility smile, and as you can see, it is different from expiration series of options. Absolutely different, but you can notice that left side, which is when BTC price will go down, is more has high bigger angle. That means that price of option will increase higher than, for example, when I am talking about this angle. It means that price of option will increase of option, I mean price of premium, cost of premium will increase very fast and very high than in case if option will go up, price of BTC will go up. So on the layer S and BTC and its price will go up, so we can see that how options premium of our options will not change so fast and so high as in short direction when it will fall. And here we can see the same angle, so it's almostly equal 0 and so on so far. Okay, so basically this is that was my idea. So sell high volatility and buy it back by lower. Oh, come on, I already log it in. Okay, okay, here we are. So BTC, and here we are. If in case we will just sell the put without any covering, we have unrestrictable losses in case if price will go down. So to hedge this, we have to buy the same strike. Okay, something like this. Very weird. Okay, so we have covered range, and basically we have no risks in case if price will go down or in price will go up. So we have risk only in case if price of at the expiration date will be at our strike. But we will wish that volatility will decrease faster than expiration will come to us, and in this way we need to pay attention to Vega. Vega means how our position will be profitable if our implied volatility will increase or decrease by 1%. So in case if our volatility, if our option construction volatility will increase on 1%, we will lose minus $15, like float PNL, like here. In case if our implied volatility of our position will decrease on 1%, we will get plus 15 bucks as our PNL. And that's why we have to sell only high volatility options and awaiting when our implied volatility will decrease. So let's return to our default initial position. This position we have the same strikes, so we have 1 point with maximum risk, but at moment when I created this position, the same strike has not super good implied volatility ratio, so I decided to make some diagonal spread. It means that we will use not only different time series of options, we will use also different strikes in different time series. So let's take a look. It was sold September 20,000. Oh, sorry, 24,000 put -1 and bought 19,000 put. So let's switch to BTC to make it more adequate. So I bought a little bit more because let me show you initial position, and let's take a look to our volatility values. So this was sold and this was bought as hedge. So sold 80% when historical volatility was about 70%, and hedged not super good, but I have not enough time to analyze entire order book, so I just take this like most suitable. So 86, that is really actually not super good because it should be ideal situation, it should be lower than sold volatility. So okay, and we have Vega negative Vega, that means that our option construction will be profitable if implied volatility of our construction will go down. Okay, let me show you historical volatility, how it looks like. Unfortunately, Deribit provides 50 days historical volatility. It's not super good, but what we have what we have. And as you can see, historical volatility is usually about 60%. So that was idea. We sold about 80% and buy about 60% or something like this, and returning to this position. So here we have some interesting situation, and we have huge risk right at our 90,000 strike. So I decided to get some funding of this construction and also make some hedge. So I did sell call and I did sell this call. Basically I bought. Basically it is another calendar but reversed. You can see. Sorry, not reverse it's diagonal calendar, but also use different strikes. So we have something like this. we still have negative Vega. That means our construction supposed decreasing of volatility, and we have, let me show initial position. We have more flat delta position, looks like almost zero. That means it doesn't matter to what side underlying asset will go, we will be about zero profit. So basically all we need is to get volatility lower and lower and lower, so to get a market calm. And let's take a look how it changes through the time. So currently let's check initial price of underlying asset. It was 23,500. So it is start point of price of underlying asset. And let's take a look what we have now. We have now 1,000 above, and we actually have amazing situation when price was in this range, and we go up and down, and basically because we have slimmer range, our volatility will decrease. And take a look what volatility we have now. Let's compare this to initial situation. Okay, let me do like this. Okay, it's amazing. So let's compare initially what we sold. We sold option by 80%, and now volatility is 72%. So basically we win 8% of volatility. Okay, that's great. Let's take a look about our hedge option. We sold it like 86 volatility percents, but now it is only 80. So here we won 8%, here we lost only 6%. So we are in 2% profit by Vega. And Vega, take a look, it increased to 33%, 34 bucks. So that means that we have 2% benefit profit in volatility. It means that at current stage we have 70 bucks profit by volatility. Okay, let's take a look about our call calendar. We sold here and buy 74. Here it is, take a look, 67. So we have 4 and 3, we have 7% profit by sold side. Let's take a look to hedge side. So 6 and 3, 9. So 9 here was, wait a second, 9, 7, so -2. So -2%, but take a look about size of position. It doubled lower than our main sold. So basically we are -1% negative. So in net we have by volatility at least 1% benefit. So let's take a look to how our option construction P&L changed from different volatility and different underlying asset price. You can see invisible power of volatility. Take a look. Here we have 23,000 of underlying asset, and we have already benefit. Let's take a look at the first picture. Let's take this P&L as zero P&L, because when I created this position, average price of main sold option was too far from market price. I guess it is because of high volatility. But let's think that it is almost the same like market price, so it is zero. Okay, so this is for $128 is 0 point for our P&L. Okay, let's take a look next. Here is end of the first day of construction created, and we already has, take a look, almost $60 of position of profit. So basically we can we could close this position with $60 profit in 23 hours. Here is time of creation position 0:22 minutes, and here is next snapshot 23 hours and 17 minutes. That's all. $60 in pocket. Good, bye bye. But okay, let's take a look. It's too low time. Let's take a look. I will here P&L volatility will increase again, and P&L will decrease. Okay, let's find the next situation when I take a look. I did snapshot almost the same time every day. Okay, 23rd of July. The most interesting situation when price will get back to initial price, like this, $23,800, 29th of July. So take a look. We have P&L like $545, so minus initial $428. We have more than $120 profit. So just did nothing at all. We did nothing at all, just waiting 8 days. That's great. Because of volatility, because of volatility get down. Take a look to values. Okay, moving next. Take a look. $584, 29th 6 p.m. almost 7 p.m. Volatility is lowest of the low. We have Vega, great working for us. 557 bucks, but it's not the most absolutely top result. Okay, here again we have 23,300 underlying asset, and we have PNL 467. So that how invisible power of volatility work, and we can see volatility was increased again. Okay, moving next. Okay, it is August 5th, and here we are. Volatility was going down. 500 profit, $574 price, almost the same as initial position price created. And here we are, we have $664 profit, exactly almost at the same price as it was created, as position was created. Take a look, it is outstanding stuff. Here we have PNL $250. We have price almost initially original price of when position was created. We have high negative Vega. That means that it is good for us if volatility will go down. And the most of important stuff, that volatility in fact went down. Take a look. So our suggestion was absolutely correct, and here we can close the position, because there is not too much time for expiration of options, and our float PNL curve will be more approximate to the expiration date curve, and that is not good for position management. So in case if market provides such profit, we have to get it. Okay, $673 for those guys with steel balls who didn't close position a few days before. It was 10th of August, so 13th of August we got some extra. Take a look, volatility was absolutely on floor. It's good. And Vega, we have Vega absolutely lower amount. Okay, and take a look again, position of price of underlying asset is absolutely at the initial price when construction was created. Oh, sorry, it's I fuck up it. It is initial price, initial screenshot. So this is basically the most outstanding. So 13th of August, basically it was done 3 hours ago. Right now it is 3 a.m. at my side, so it was done 3 hours ago. And that's great, guys. So definitely I will continue to paper trades on crypto. At first and probably in next month I will deposit, I guess, Solana, I think Solana or Ethereum, because probably Ethereum, because BTC, even if you have for example, like I have portfolio margin account, which should be decrease deposited margin for open position, but anyway this position has too high margin. For example, for this position your margin will be, as I calculated, not sure that I'm 100% right, but it was about $2,000. So in case if we did 250 bucks in for example, how many days, let's take a look. So we open it in 21st, so 1 week, 2 week, 3 week, okay, 3 week, in 3 week, okay. So we did about 12 persons and we did nothing at all, just created position and just control it, that's all. In case if price will go here, of course we will do something. We will do some approaches to manage of position by buying or selling options and so on so far. But doing nothing and getting 12 persons basically for no risk construction, because we have, remember, we have delta neutral initial originally, we have delta neutral strategy, so it doesn't matter to what direction price will go, we always in the profit or slight negative zero. So basically if we will take a look to this position, I made it like slightly delta negative in case if price will go down, because if price will go down we have increased volatility, so Vega will work against us and we will get some negative PNL by volatility, but delta should partially cover this negative, because it will negative by itself, so we have a little short position here in this direction. In case if we will go up, our volatility skew means that volatility will go down, so Vega will work for us and we will get amazing benefit by Vega, but little negative by delta, like we have short but price goes against us, but in this case Vega will pull up us from negative situation. That was my great main idea and how real market has showed it works. So basically that's all what I would like to show you. Definitely if we will use Ethereum, margin will be lower, probably we can open more position at the same deposit and we can make some bigger amount of money. Actually Deribit provides also Solana options, and probably I will try it at first, but I am confused that we have no position builders for Solana. It's weird, but I found some Python libraries to build some position and plot it. So basically here is Solana option desk, and we can see, for example, September 30. What is current price of Solana? Huh. Solana BTC. Okay. Oh, why BTC though? Looks like I need some sleep. $46. Okay. So let's get central strike. Here is option call, and take a look. Let's, for example, try to buy one Solana contract, call contract, September expiration. And for example, what will be our margin? Only 15 cents for sell and 90 cents for buy. Option very weird, because usually sell margin will cost more than buy margin. Okay, and here we have total not super liquid, because we have only 2 contracts for buy, but it's not super bad, because it's enough. Okay, so because you can put just a little money, for example $8, $9, and you can buy this contract, so you don't need huge deposit. And that is why I would like to trade, for example, Solana. Let's take a look to Ethereum. What is about Ethereum? Ethereum, what is price of Ethereum? Almost 2k. Oh great, I have sell order about $2020 and $200. Okay, so 2000. Here is central strike. Basically here is we have price. Okay, quantity 1, sell margin without any PM account, so we have 0.13 of Ethereum, so we have to multiply it on current market price to get USDT value. So like this. Okay, let's take this, and so this will be our margin for selling one contract of Ethereum. So not so much, so and looks like affordable to make some trades and try options on crypto. So that's all for now. Thank you for watching. Press like button if you will get some interesting information, and see you in next videos. Bye.